So you're running a business here in Canada, and you know you need that one piece of new equipment to really take things to the next level. But man, the idea of dropping all that cash up front, it's enough to keep you up at night, wondering if it'll totally wreck your cash flow. Well, in this explainer, we're going to break down exactly how you can get the tools you need to grow without breaking the bank. Yeah, if this question is hitting a little too close to home, I just want you to know you are not alone, not by a long shot. It's that classic business problem, right? You got to spend money to make money, but spending that money feels like a huge, massive gamble. It's a totally normal, everyday part of being a business owner. And really, you're in some pretty good company. Get this. Almost 8 out of every 10 companies in Canada use some kind of financing to get their equipment. This isn't some last-ditch effort. It's actually just a smart business move. It lets you get the gear you need right now, and then you pay for it as it starts making you money. That's the whole idea. Okay, so when you decide to go the financing route, you're basically standing at a fork in the road, and it really all boils down to two big ideas, two different philosophies. On one path, you've got long-term ownership, building assets for your company. On the other path, it's all about just having access to the best, most current tools, with total flexibility. Let's dig into both. First up, let's talk about the ownership path. This is your classic $1 buyout lease. Honestly, the easiest way to think about it is like a rent-to-own plan for your business. You make your monthly payments month after month, and at the very end of the whole thing, you pay a single loonie, and that piece of equipment is 100% yours. It's an absolute no-brainer for the real workhorses of your business. You know, the heavy machinery, the manufacturing gear, the stuff you know you'll be using for years and years. Now, let's look at the other side of the coin. The fair market value lease, or you will just hear it called an FMV lease. This one isn't about owning anything, it's all about access. It's about being nimble. The best comparison, for sure, is leasing a car. You get to drive the newest model, it has all the bells and whistles, your monthly payments are lower, and when the lease is up, you just hand the keys back and get the next new thing. This is a total game changer for anything that gets outdated fast. Think computers, high-end medical equipment, servers, that kind of stuff. So let's put these two options side by side. The $1 buyout, yeah, your monthly payments are going to be a bit higher, but at the end, you own the asset. The FMV lease, your monthly payments are lower, which is great for cash flow, but at the end, you walk away with nothing. So you can see there is no single right answer here. It's a strategic choice, and it completely depends on what that specific piece of equipment is supposed to do for your business. All right, now that we've got the two main paths down, we need to talk about let's call it the not so fun part. The equipment financing world isn't as regulated as you might think, and there are some really common traps hidden in the fine print that can cost you an absolute fortune if you don't know what you're looking for. Just take a look at this quote. This is from a real business owner who got snagged by one of the worst traps in the industry. I want you to just imagine that for a second, paying over $20,000 for a single laptop. How does that even happen? Well, it happens because of something sneaky called an evergreen clause. So what is this thing? An evergreen clause is a little piece of text in your contract that says if you don't send a written notice to the leasing company, and we're talking usually a full 90 days before your lease is even over, it will automatically renew for another 6 or even 12 months. You think you're done, you've made every single payment, but suddenly, the bills just keep coming. And believe it or not, it's perfectly legal in most of Canada, so you've got to be so careful. Here's another little trick you got to watch out for: misleading rates. You'll see an ad for, say, 5.1% interest and think, wow, that's a pretty good deal. But what they're often showing you is something called simple interest, which is not the APR you're used to seeing on a car loan or a mortgage. Simple interest is a flat calculation that doesn't really account for your balance going down over time. So when you do the real math to find the true cost of borrowing, the annual percentage rate, the APR, that nice 5.1% suddenly becomes 9.6%. It's a massive difference, and it's designed to be confusing. And this one is huge, especially if you're looking at buying used equipment from a private seller. Somebody gives you a bill of sale, they shake your hand, they tell you it's all paid off, you're good to go, right? Well, not so fast. How do you actually protect yourself? The answer is something called a PPSA search. Think of it like a background check, but for a piece of equipment. In Canada, when a lender finances something, they register a financial claim or a lien against it. A PPSA search lets you see if the thing you're about to buy already has one of those claims on it. And this is the part that gets everybody. A bill of sale does not clear old liens. If you buy that equipment without checking, guess what? You might have just bought someone else's debt. All right, let's fast forward. You've navigated all the tricky parts, you've made your payments on time, and you can see the finish line. The lease is almost up. So, what happens now? Well, what happens now was actually decided way back when you first signed that contract, which is why you have to understand these options from day one. So, it usually breaks down into one of three scenarios. The $1 buyout? That's easy. You pay your dollar, you get the title, it's yours. Then you've got your 10% or fair market value options. This just means you have the choice to buy the equipment for a pre-agreed percentage or whatever it's worth at that moment. And finally, you can just return it. But be careful with that last one. Always check the fine print for rules about its condition, because you could get hit with extra fees if there are dings and scratches. I hear this question all the time. Business is having a great year, you've got some extra cash sitting in the bank, and you get this totally logical thought, hey, I'll just pay off this lease early and save a ton of money on interest. Makes perfect sense, right? Well, unfortunately, in the world of leasing, it almost never works out that way. Here is the hard truth that almost nobody explains. When you try to pay off a lease early, you're not just paying back the money you still owe on the equipment. You're paying for the lender's guaranteed profit that they already baked into the contract. They were counting on all those payments. So the discount they give you for paying it off early is tiny, like maybe 2 to 5% of your remaining payments. Honestly, it's often cheaper to just write out the contract. Phew, okay, that was a lot of information, I know. With all these options, all these traps, how do you actually make a choice that you can feel good about? Well, we can actually boil this entire thing down to a really simple 3-step framework that's going to give you all the clarity you need. Here it is. It's that simple. First, just look at the asset itself. Is it a big piece of machinery that's going to last for 20 years? You should probably lean towards the $1 buyout. Is it a computer that's going to be a paperweight in 3 years? Go with the FMV lease. Second, look at your market. Is having the absolute latest and greatest tech the only way to compete? Then flexibility is your best friend. And third, and seriously, do not skip this one, talk to your tax advisor. They can actually run the numbers and show you in black and white which of these options is going to save you the most money. Because you see, at the end of the day, this whole conversation isn't really just about a monthly payment. It's a much bigger, more fundamental question about the kind of company you are trying to build. And the answer to that question, well, that will tell you exactly which path you need to take.